topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome. It's just another week. This year is flying by already. I mean, we're in the middle of February and tax season's progressing. It's been a little bit slow as far as, people coming in and getting returns done. But they're getting information to us, and it's been a slow but sure and steady process. It's one of those things, when tax laws change, sometimes it's slower getting all the updates in the software and making sure that, the things that were implemented for 2025 are actually in the software. But 2026, hey, we're moving through, shaping up. It's going to be a great year for trucker tax tools and taxation solutions, helping people save money on their taxes, fighting the IRS with IRS problems, and doing all the fun things that we get to do to help you, the everyday taxpayer, small businesses. And today we're talking about, business taxes. For 2026, business obligations are determined primarily by your legal entity structure and federal regulations under the One Big Beautiful Bill, which made a lot of business-friendly provisions permanent for both 2025 and 2026. And hey, if you are a corporation that's filing an 1120, you're a C Corp, your income tax rate remains a flat 21% for C Corps. Now, if you have selected to become a C Corp or stay a C Corp, because the IRS, when you incorporate your business, so John Doe Consulting, Inc., and you file for your employer identification number, automatically give you the designation of C Corp. So if you are a C Corp and you're paying the 21% tax, remember anything that is distributed to you is considered a dividend and then is taxed as well on your personal return for dividends. So you do have double taxation in that respect if you are a C Corp. And if you're a C Corp, you need to be making sure that you're on payroll if you're working in the business. If you're just hiring contractors, make sure you're following all the IRS rules and guidelines for having contractors working in your business. Now, if you have people that you are dictating what they do, how they do, and when they do, and have control over that, then those are W-2 employees and should be on payroll as well, not as an independent contractor. So, hey, that being said, remember, your federal tax rates are done by entity type. Now, that's 25, 2026. It's the way your business is organized. It's going to dictate whether you pay taxes directly or it passes income to you, the owner, to be taxed at your individual rate. Again, C Corps, 21% tax on all profits from the business. Sole proprietors, single member LLCs, your profits are taxed at your individual tax rates, which range from 10% to 37% for 25 and 26. So this is going to be filed on Schedule C. Now, if you're a multi-member LLC, you could be considered a partnership. And it is a pass-through entity. The business itself generally pays no federal income tax. Instead, you and the other owners pay individual income tax on your share of the profit. Now, you also, if you're working in the business, and it could be one owner works in the business, one could be passive and is just an investor, you must have what would be considered a guaranteed payment, kind of like a guaranteed salary. It just doesn't run through payroll. It runs through as guaranteed payments, and that's split out on the K1. So you have that to deal with as well. Now, that guaranteed payment is what's taxed for self-employment tax, and we'll get to that in a minute. S Corps. So if you are an S Corp and you've made the election with the federal government. Now, people get confused because they think, hey, I went and said I wanted to be an S Corp when I applied for my corporation at the state level. But that's not a designation from state level. It is the designation through the IRS, and you must make that election and make that election timely. So you have the first 2.5 months of every year, or basically 60 days after your corporate filing is in, not your tax filing, but a filing for your employer identification number, to make that election through Form 2553. Once it's accepted by the IRS, then you are considered to be an S Corp, starting with the period that they accepted you for. Now, what does that mean? Again, it's a pass-through entity. The business itself will not pay federal income tax. Instead, you and all other owners of the business will pay individual income tax on their share of the profit. Now, the profit in both the partnerships and S Corps get taxed for federal income tax, but is not taxed for Social Security and Medicare. So there's no self-employment tax except for on the guaranteed payments. And then S Corps, you are required to have a reasonable salary for what you do in the business. Now, that can be broken down many different ways, from a high-level CEO type perspective to all the way down to janitorial services, let's say. And your roles could vary and pay could vary based on the role that you have within the business. So the idea is making sure that you have what is called a reasonable salary for your business, and it is run through payroll, and you're paying all the payroll taxes. So you're doing federal withholding, you're taking out Social Security and Medicare, and then you're doing the employer match for Social Security and Medicare. And then at the end of the year, you have to file your W-2s. And depending on how the IRS has set your business up, you may be filing 941s every quarter and a 940 at the end of every year as well. So you got to read your employer letter to know exactly which way you're set up and what way the IRS expects the filings to happen. So yes, it does get complicated, but the first thing you need to do is read. So if you haven't read it and you haven't looked at it, pull out that letter from the IRS that gave you your employer identification number And that will give you everything that you need to know as far as how they originally set you up for filing. Now, if you made the election for S Corp, then you should have a second letter from the IRS that gives you the S Corp acceptance, will give you the start date of your S Corp and when that election took effect. And then you know exactly how you need to file for your corporation. If you filed as an LLC and you were a single member, again, that EIN letter is going to designate that you were the sole member, and then it's just filed part of your 1040 on Schedule C. Unless you made the S Corp election, and then you would have that S Corp election letter when they accepted it to designate that you would have to file as an S Corp and file an 1120S. So it's about reading, making sure that you are set up correctly and that you have everything that you need to have the right taxes being done for you. We've seen a lot of mistakes, and we've seen mistakes by CPAs, enrolled agents, people that you've hired to do your taxes. And those mistakes are filing the wrong forms that were required, not filing payroll tax returns and things like that. And it becomes very problematic and very troublesome. Hey, we're going to take a short break and we're going to talk a little bit more about what happens when you don't read those letters, and then what does the IRS expect from you? And we'll do that right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. And so what happens? Man, you got that EIN letter. You may have made the election for S Corp. You don't know. So what happens? Well, generally, here's what happens. You walk in, you say, hey, I have this company. I run this company. I am an S Corp. So I need to file. The preparer doesn't ask you any questions about, hey, let me see your EIN or the acceptance letter for the S Corp. Or maybe you were a multi-member partnership or even a single member LLC, whatever it is, you didn't know. You just thought because, hey, I wanted to be an S Corp. And so you walk in and then make the filing. And matter of fact, a lot of times they can e-file those returns and not get a rejection. And then 6 months later, 9 months later, the IRS sends you a letter and says, hey, you filed the wrong return. It happens. Or you were a sole member LLC, but the IRS puts you down as a partnership as if it was a multi-member because of the way you filled out your SS4, which is the application for the employer identification number. And you filed as part of Schedule C and paid the taxes. And then the IRS comes back and says, hey, where's your partnership return? And that happens a year or two down the road. Now, what do you got to do? You got to go back and amend those returns. Unless you were really a sole member, then you would go back and prove to the IRS that there were no other members for this company, and there shouldn't be partnership returns that are out there. Now, you filed as a incorporated business. Hey, Widgets Inc. And you got your employer identification number. It told you to file an 1120, and you go in and you file an 1120S because that's what you told your preparer. Your preparer didn't know. They didn't ask. They trusted that you knew what you were doing in your business. You know, we use a little philosophy around here, trust but verify. We want to verify that you are correct in your filing, so we will ask for that acceptance letter. And many times you don't have it. So then maybe we make the election with the tax return as a late election and get you approved as an S Corp. But this is sometimes it takes them a couple of years to catch up to you. And then they come back and say, no, you filed incorrectly. These shouldn't have been. You should have been filing as an Inc. And now they don't have time for you to correct it. You got to go back and file it as an 1120. And you didn't have payroll, and you made distributions to yourself. So therefore, you got taxed at the 21%, and now you have dividend tax. And you violated one of the biggest rules of having a reasonable salary for the work that you're doing in the business. Becomes problematic. IRS is now compounding the issues and the problems that you have created because you did not follow through, didn't know what was going on and how to do this in your business. So if you started your business in 2025 and you're going to prepare right now, when you come to us over here at Trucker Tax Tools, Taxation Solutions, the first thing you want to present to us is your employer identification letter. And if you made the election for S Corp, your S Corp status approval letter. We will want both of those to verify how you were set up. Because we don't want problems for you. We want to straighten those problems out before it becomes a bigger issue with the IRS. If you're going to someone else, go in armed with those two letters so that you can show to them that the designation is correct. Matter of fact, I suggest you find those letters if you've been filing for the last year or two as well. Find those letters if you haven't already provided them to your tax preparer and bring them in with you so that they can verify that you're filing correctly as well. You know, if you were required to file payroll, the IRS expects 940s, 941s, or 944, or 943 filed regardless of whether you had payroll or not. So you may have set up a company 2 years ago and it may have been dormant. But it wasn't dormant really with the IRS. It was dormant in your mind. But according to the IRS, you still should have been filing all the required forms. That includes if you were required to file 1120 or 1120S, they've got to be filed regardless of whether you made any money at all. They do expect a zero return every year, even though you didn't do anything in the business, you have it set up, you have it running, supposedly, and the IRS doesn't know. And that's their way of knowing. So unlike a personal filing, if you've made no money, you wouldn't have to file. If you had zero income, you wouldn't have to file. Unfortunately, when you're running a business and you have to file an 1120 or 1120S, they expect those returns regardless of whether there was income or not. So, hey, what are your key filing deadlines for 2026? This year, the first one's already passed, February 2nd. You had to have your W-2s in, your 1099 NECs out to your contractors. You should have had this done already. If you haven't, get it out now. Get it done. March 16th. You know, there is a filing deadline on March 16th. And that's deadlines for S corps and partnerships to file, the 1120S for the S corp and the 1065 for partnerships. If you can't meet the deadline coming up in the next month, get your extensions in. They will give you a 6-month extension on that, but you need to make sure you file for that extension. There is no excuse, even if you have zero net income or losses, to not have the extension filed, because they don't base this on income. They base this on K-1s that are due to the owners of the business, and then they penalize you for every month for every owner that you should have had the K-1s out by March 16th. So, hey, even if you don't think you're going to miss the deadline, get the extension in anyway. It doesn't hurt you one iota. Matter of fact, we do that for a lot of our clients complimentary right away, so that, hey, we know that there's not going to be any deadlines missed. We know that, hey, even if we cannot make the deadline, you have an extension out there because, we need more time. You need more time. We do this to make sure that, hey, you're not going to have penalties because you're filing late. April 15th. Yep, we know individual tax returns, Schedule C tax returns, they are due April 15th. The other one is C Corps. If you're running a C Corp, your deadline is April 15th as well. So don't miss the extension deadline. Yes, I know. If you don't owe money and the IRS owes you money, you technically wouldn't have to file this extension. I say do it anyway. Always put the extension in. If we're working on an IRS problem and you don't have an extension in, the IRS is going to say you're not in compliance because you didn't file your return, you didn't have an extension. Even if you're going to get money back, we would have to prove it to them. So, hey, file an extension, because you never know. Maybe there's some other income. Maybe you're waiting on a K-1 and all of a sudden that K-1 comes in and it's got a lot more money on it as income than you thought. So maybe you're invested or you're part of the partnership and you never know what that partnership's going to do because they didn't provide you financial statements. Hey, I'm invested in a company like that. These guys think they were smooth and great running an app, but they can't even give us quarterly financial statements. It is what it is. We know it, we expect it, so we plan around it. You may be invested in a business like that as well. And if you are, hey, just in case, make sure you have that extension for your personal returns as well. And if you're invested in a business, hey, go back. If it's a partnership or S Corp, make sure they've filed their extension timely as well, because you don't want to be involved in the business that's getting penalized for something that was so simple and easy to do. And quarterly estimated tax payments. If you're a business owner, you probably should be aware of what your estimated tax payments are and when you got to make them. Unfortunately, the first one's due April 15th, and then June 15th, September 15th, and January 15th. So you've got to make sure you're making those estimated tax payments as well. Wow, we're having fun. We're getting through this. We're going to take a short break. When we come back, we're going to talk about major 2026 deductions and changes for taxes for your business. And we'll do that right after this break.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for you. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. One big beautiful bill had a lot of changes in it, deductions, things that you can use for your business. And, that legislation that passes is there to save you a lot of money. You got to use it in the right way. You've got to think about things before you do them. Having somebody on your side, and we tell truckers this, owner operators this all the time. Hey, when you come to us, we're helping you with tax planning. We're helping you minimize your taxes, maximize your profits, keep more money in your pocket. That's what we're all about. Our fees, we charge are tax deductible as well. So you're saving money to help your business. And hey, at Trucker Tax Tools, we got some great low rates. So go to truckertaxtools.com, touch base with us over there, and make sure that you're getting the right deductions for your business. We know trucking inside and out. We know businesses. We're here to help you run your business much smoother and guide you down the road. Hey, some of this recent legislation that altered several critical tax benefits for your business are important, such as 100% bonus depreciation. This was made permanent, allowing you and your business to immediately deduct the full cost of qualifying assets, equipment, machinery. And you can do this in the first year. Going out and buying a new tractor, trailers, things like that can help you with bonus depreciation. Now, does it make it right for everybody to jump out and buy a brand new truck to get bonus depreciation? No. And don't let people tell you that, hey, just to do this for the tax savings. There's got to be other business reasons behind it. And let's talk about it. Let's discuss it so that you can make the right decision for yourself and for your business. Qualified Business Income Deduction, QBI, Section 199A. 20% deduction for pass-through entities is now permanent. For 2026, anyone with at least $1,000 in qualified business income is going to receive a minimum of a $400 deduction. So, hey, you got some benefits out there. We got to use them and use them to your benefit. R&D, research and development expensing. Domestic research and development costs can now be fully depreciated and are deducted in the year incurred rather than being amortized over 5 years. So if you're a company that's doing research and development, you're able to expense it in the first year rather than amortizing it in over a 5-year period. So it's something that really can help you out in research and development. Employer child care credit. This has been significantly expanded for 2026, allowing small business to claim up to 50% of eligible costs with an annual cap of $600,000. Hey, it's worth looking into. If you've got employees and they're having child care, you can probably help them out and claim this child care credit to help your business and help the employees that work for you. And this is one thing, this is one of the areas that I really, really liked about the One Big Beautiful Bill. And this has been needing updating and changing for a long time. 1099 reporting. So the threshold has actually changed for issuing 1099 NECs and 1099 miscellaneouses to up to $2,000. So you would have to pay people out of your pocket out of the business, $2,000 or more, to actually issue 1099s for 2026. That has gone up from $600. And if I'm correct, they're also indexing this for inflation, so that as inflation causes income and levels to go up, costs going up, you'll be able to do that as well. Now, hey, you're doing taxes and everything else. You really got to think a little bit about the states. States can vary significantly from state to state to state. 6 states in 2026 don't levy a corporate income tax. So Nevada, Ohio, South Dakota, Texas, Washington, Wyoming, they don't levy a corporate income tax, although some have a gross receipts tax or a franchise tax instead. Texas has a franchise tax. You got to be over like 2.8 million in revenue before franchise tax kicks in. But once you top that, it's 1% of revenue. So it becomes a very costly tax for a corporation if you are a large or small business out there. On the reverse side, states like New Jersey have a top tax exceeding 11%. So, kind of got to think about what states you're in. So, Nevada has a commerce tax on gross revenues. It kicks in at a high level. Ohio levies the commercial activity tax. Washington assesses the business and occupation tax. And, so you have a lot of different ways of looking at things, but you got to look at the corporate taxes that are out there. Alabama has like a 6.5% flat tax rate on all taxable income. Alaska runs from 0 to 9.4%. That's graduated based on brackets you may be in. Arizona has about a 4.9% flat rate. Arkansas varies from 1 to 4.3%. California, 8.84% flat rate on all taxable income. Colorado, 4.4%. Connecticut, 7.5%. 8.25% for income over 100 million. Delaware, 8.7% on all taxable income. Florida, 5.5% flat rate. The first 50,000 is exempt though. Georgia, 5.19% flat. Hawaii, 4.4 to 6.4 graduated. Idaho, 5.3% flat. Illinois, this may be the top rate out there, 9.5% flat rate. Indiana, 4.9% flat rate. Iowa, 5.5 to 7.1, and that's graduated. Kansas, 4 to 7% graduated. Kentucky, 5%. Louisiana, 5.5%. Now, Louisiana has some graduated rates of 3.5 up to the first 50,000, and then 5.5 to 150,000, and then 7.5 above that. But it does say it's a flat rate, so I'm kind of confused that they give us some of these variables out there as well. Maine, 3.5 to 8.93%. Maryland, 8.25%. Massachusetts, 8%. Michigan, 6%. Minnesota, 9.8%. Do we know where all that money's going? Oh, just kidding. I mean, we shouldn't get into politics on those kind of things. But we do know some people's pockets have gotten lined pretty well up there. Mississippi, 4 to 5%. Missouri, 4%. Montana, 6.75%. Nebraska, 4.55%. Nevada, No corporate income tax. Nada. Nothing. New Jersey, 6.5 to 11.5. New Mexico, 5.9%. New York, 6.5 to 7.25. North Carolina, 2%. That's not a bad rate. It's pretty good. North Dakota, 1.4 to 4.13. Ohio, no corporate income tax. Now, they did have that other tax out there, so they are charging some stuff for the corporations. Oklahoma, 4%. Oregon, 6.6 to 7.6. Pennsylvania, 7.49. Rhode Island, 7%. South Carolina, 5%. South Dakota, hey, another good state you might want to operate in. No corporate income tax. Tennessee, 6.5%. Texas, no corporate income tax, but we do have that franchise tax that's here. Utah, 4.5%. Vermont, 7 to 8.5%. Virginia, 6%. Washington, no corporate income tax, but again, they have that margin tax and stuff there. West Virginia, 6.5% flat. Wisconsin, 7.9% flat. Wyoming, nothing, nada, no corporate income tax. District of Columbia, 8.25%. So you see, every state varies out there. There are some states that are a lot more expensive when you're looking at, net income and what they're going to charge you as a tax rate. So you want to be watching where you are in business. Now, just because you charter your business, let's say in Nevada, where there's no corporate income tax, but you operate out of a state like California, you are going to pay California's tax, and you have to register your company as a foreign corporation there. They use those terms as foreign corporations, meaning that you incorporated in another state, but you're operating in that state. Same with Texas and a lot of other states. So if you're operating in that state, you would still be subject to their state tax rate for what the operations are in that state. So if you've got multiple locations, so let's say you're in Texas, New York, California, Ohio, realize that, hey, the earnings from each of those individual states where your businesses are located, you would be subject to the state income tax for the operation in that state. So in the operation of state of New York or California, you would be paying their tax based on those operations there locally. Now, not a global tax, but based on what you've done in locality. So you're going to want to make sure that you're tracking what is made in that state versus what's made in all the other states out there. So if you happen to be going through and operating in 6 or 7 different states, you would pay the state income tax in the state that you're actually operating in. Yeah, you talk about a lot of work. That would be a lot of work. It's a lot of work just deciphering, hey, 1, where should I be located? 2, okay, this is where I live, so I'm obviously going to be operating out of the state that I live in. Sometimes I question why somebody would want to live in a state that's going to charge them, almost 9%, or in the case of Illinois, flat rate of 9.5%. It's a huge hit for income tax when you think about it, because they're going to take quite a bit of money from you while you're in your business. Hey, we're going to take a short break. We're going to talk about one of my favorite rules, and it's a question that we get quite a bit. What is the IRS 14-day Augusta rule? And we're going to do that right after this.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We've had people come to us and go, "Oh, do you know what the Augusta rule is?" Yeah, we're professionals. We are knowledgeable. We understand that 14-day rule. Now, does everybody understand that 14-day rule? So if you're a business owner and a homeowner, this IRS 14-day rule, or the Augusta rule, as they call it, allows the homeowners to rent out your residence for 14 days or less per year without reporting income to the IRS, making it tax-free. So maybe, hey, you do Airbnb for 14 days because you're going on vacation, or maybe you're taking a 14-day cruise and you want to rent your house out. As long as it's rented out for 14 days or less, that income is tax-free. Now, if you rent your home for 15 days or more, then all income must be reported and the property classified as rental, requiring strict prorated deduction limits. So if you're following the 14-day rule and you are renting your home out for just the 14 days, again, that income is tax-free. You don't report it. And as long as it's at a fair rental value. So, okay, I decided I want to rent my home out and I'm going to charge my business $10,000 a day. No, that is not going to cut it. That is not a fair rental rate. Well, okay. Maybe if you got a multi-million-dollar home and maybe it's on a lakefront and yes, everybody around you rents for $10,000 a day. Well, I guess that's a fair rental rate. But most of us aren't in that situation. And $10,000 would be absorbent. So it's still got to be a fair rental rate. You don't get any deductions. So if you use this 14-day exemption, you cannot deduct any rental related expenses. So no cleaning, no management fees, no maintenance, nothing. No depreciation. You're taking no deductions against that 14 days of rental income. If you're running your own business, you can rent your own home, take the deduction for the 14-day rental on your corporation, and take the income tax-free as long as it's quote unquote 14 days. Do a lease agreement. So have the agreement. Have your business pay for the cleaning of the rental when you're done renting the house from yourself. Those are things you can do. Now, you can't take the home office deduction in this 14-day rule, so don't bother with that. But it does give you that deduction. So, personal use thresholds. The rule applies if you use the property for personal purposes for more than 14 days or more than 10% of the total days rented to others. So though that rule will apply. 15th day rule. As soon as you rent the property for the 15th day or more, all, and they mean all, rental income becomes taxable income. So you no longer get to take advantage of the 14-day rule. It is gone because you rented it for a 15th day. Now, keep records. All right. It's essential. Track your personal days, track the rental days to make sure that you comply with IRS regulations. If you're renting it to your business like one day at a time, maybe they're having parties, maybe it's doing marketing meetings, make sure that it's a fair daily rental, and then make sure you do not exceed the 14-day rule to get the tax-free income. You still get the deduction for the business, but that rental income is tax-free as long as you got that 14 days. So the IRS says what constitutes a day? Rental day. Any day the property is rented for a fair price. Not too low, not too high, fair price. Personal days. Any day the owner, family members, or other owners use the property. So you got to be aware of those things there. Now, some common pitfalls: you exceed the 14 days. May have happened on an accident, you went to 15. Now you flip the property into taxable, reportable rental. Take your deductions and report the income and expenses, and it is what it is. Miscounting days. You included maintenance days as rental days, or forgetting to count personal days can cause errors as well. Now, if this is your main home and you're leasing it to you, let's say your business, or let's just say you do it through an Airbnb and you set up a couple of weekends where people can use it. You're leasing it Friday, Saturday, and Sunday. You could do that 4 times, and that would be 16 days, or that's 3 days. So that would be 12 days. So you'd be fine. You do it a 4th time, you're at 16 and you're in the negative, and you've gone over. Now you're reporting on your rental income. So keep those things in mind. You may have local taxes on that. So even if your income is tax-free for federal purposes, you may still owe lodging taxes for this rental as well. So like if you're doing through Airbnb, they'll probably tell you you're going to have some lodging taxes as well. So make sure you're collecting those lodging taxes from whoever you're leasing to, and make sure those taxes are getting remitted to the government. You do not want to miss any of those things there. So what do you do as a business owner? Hey, file timely. If you're not going to make your timely filings, file an extension. Make sure you're making your estimated tax payments if you're required to make estimated tax payments. If you file an extension, make sure you get the returns filed timely as well with the extension. That means you get a 6-month extension. That means you've got to make sure you're making those filings. So don't miss those deadlines. And above all, get a good tax preparer who's going to look after you, help you out, double check you, and give you the information that you need to help you run your business. Hey, we here at Trucker Tax Tools, we're here to help businesses, owner operators, every day in their trucking business. Give us a call. Let us help you be better at what you do for your business. Call us today. Don't miss our great low rates, 877-966-2477. Again, 877-966-2477. Be here every Monday, 10 a.m. Eastern Time on W4CY Radio. Let us talk about your taxes. Let us help you through figuring out the tax code. Next week, we're going to talk about IRS problems, solutions, and audits. So be here next week, Monday at 10 a.m. Eastern Time at Tax Talk for you. You can, if you miss one of the episodes, you can go to Tax Talk, 4u.com, and find one of our podcasts there. Find it over on iHeart or Speaker, any of the podcast hosting sites out there where you can get our information. But just be here Mondays, 10 a.m. Eastern Time. Look forward to seeing you next week. You have a God bless and glorious week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalkforyou.com. See you next week at W4CY.com.